Hello and welcome to the Three Questions podcast, where we dive deep into the world of wealth management and connect you with industry experts. I'm your host, Wayne Baxter, Senior Executive Manager at One Capital. Now, today we're exploring a hot topic in the investment world, private assets. I'm sure you've heard all about it. With markets evolving rapidly, more high net worth investors are considering ramping up their exposure to alternative investments like private equity, private credit, and infrastructure investments. But the question is it the right move? We're going to break that down today. And our topic is the three questions high net worth investors should ask before increasing their exposure to private assets. Thank you for taking time to check us out. And if you enjoy this episode of the Three Questions podcast, please consider liking this video and subscribing to our podcast and YouTube channels. Private assets have traditionally been the domain of institutional investors and ultra-wealthy families. They offer potential for higher returns and diversification beyond the publicly traded markets. But in recent years, they've become more accessible to a broader range of high net worth investors. This shift is driven by factors such as regulatory changes enabling retail access and a growing appetite for real economy investments amid volatile stocks. However, with great opportunity comes complexity. Issues like liquidity, risk assessment, and portfolio asset allocation thresholds, to name a few. So we're going to address them today as we explore the three questions high net worth investors should ask before increasing their private assets. Joining me to unpack this is Dr. Kelsey Syvrud. Dr. Syvrud, great to see you. Thank you for
Nice seeing you as well. Thank you for having me today, Wayne.
It's my pleasure. Just for our listeners to know, Dr. Syvrud is the Assistant Department Chair and Associate Lecturer in the Department of Finance at Florida State University's College of Business, where she also serves as Director of the Gene Taylor Banking and Financial Studies Center. She has a PhD, an MS, and a BS in Finance from FSU. Her expertise spans multinational and corporate finance, financial data analytics, fellow nerd, we'll say.
Yes.
Finance, politics, finance, entrepreneurship, contracts, and procurement. You have a lot on your plate. Dr. Syvrud is also instrumental in teaching those topics at both undergraduate and graduate level. Now, she also has collaborated with One Capital Management here recently on developing our 2025 continuing education program, which centered on private assets, including private equity, private credit, and infrastructure. It's this deep knowledge that compelled me. In fact, during our continuing education sessions, I actually went up to her during one of the breaks and said, "We need to talk." Basically, I said, I thought Dr. Syvrud would be a great guest, and it would be a good opportunity for us to get to know you and learn about your expertise. So maybe just to get the ball rolling here, if you could just give our audience a quick overview of your journey in finance and what drew you to specialize in this private asset space.
Yes. I came up in a traditional academic program, so I went through my PhD. And while I was there, a lot of my dissertation focused on private equity and venture capital firms. So even when I was really young in my career in the academic journey, I kind of got interested in this space. It was very burgeoning at the time, very, very small compared to what it is today. And then when I went out into industry after I graduated with my PhD, I went and worked for corporate litigation cases where I got to see some of the cases dealing with private equity, dealing with these GP-LP relationships before transitioning into a ultra high net worth multifamily office where I was a director of investment strategy, and we did a lot of private placements in private markets and really expanded my abilities at the portfolio construction level. So I'd say when I first started my journey, I was looking at the individual portfolio companies like a deal by deal basis. And as I expanded and increased in my career, I got more into the whole portfolio construction. And it was just something that fascinated me. It was very new. Probably being in academia, I'm a nerd, so I like new things. I like to learn all the time. And so it was just kind of like this undeveloped, unexplored, wild, wild west. And I would say that's what attracted me to it.
And that's a part of it too. It's a bit of the wild, wild west in the world of private assets. So before we get to our questions, I think that's actually good unintended segue. So to talk about how private assets have evolved.
Yes.
Again, these investments were sort of locked behind barriers, in my view. I think multi-million-dollar minimum investment requirements. There were long lockout periods, mainly for pensions and endowments. That's where they domicile, right? Now,
Mhm.
we've seen over the past decade, especially post 2020, they've become more mainstream and more accessible. And again, you could look at, the SEC's updated variables for accredited investor rules that now allow high net worth investors to participate with as little as a $25,000 investment in some cases. So, what precipitated or what is behind this shift in your view?
I think there are a couple things, and part of it is one of the roles that the SEC was created for is to protect investors.
Of
And
course.
when it was the Wild Wild West, and it's still a little bit the Wild Wild West, but it's certainly matured compared to where it was maybe in 2000, 2001. And I think that when it was the Wild Wild West, they were not letting just anybody, any investor into these things, and the market itself had to mature. And it's now had 25 years or so to mature into where it's now I think it's a close to $20 trillion. I know it's like at least $19.5 trillion market in private markets compared to 1 trillion back in that 25 years ago. So just in 25 years, 1 trillion up to 20 trillion. It's now a meaningfully sized market. I think all of us have kind of now had more experience. There's certifications on it, there's papers on it, there's research on it, there's a bit more understanding to allow the SEC to ease those restrictions and let people come in. At the same time, another barrier was just the format or structure in which you entered these investments. It used to be only a direct investment or a traditional drawdown fund, which has very long lockup periods. It's very opaque. There's not a lot of transparency. There's not a lot of regulations around what they have to report to you, a lot less investor protections. And so naturally, you did not have a format for the majority of the market to enter. And now, with the rise of evergreen structures, with the rise of some of these 40 Act funds, which are just like your mutual fund and ETFs from a structure perspective, and have some of that tax efficiency, have some of that transparency and investor protections, that's now allowing investors to come in. And I think on the manager side, the actual funds themselves, they look at the balance sheet of high net worth investors and the amount of assets that are there and under allocated to private markets. And so you kind of have this triangle of investors haven't been able to access it, and now they can with the regulation, the maturation of the market. You've got the structures that are now allowing them to do so in a more protected and easy on everybody standard. And you have the managers who are like, oh no, this is a good market for us to be in. And you've seen just this clamber of private market structures and funds coming to be accessible to the high net worth investor base.
One of the attractions of private assets, as you know, is that they can offer uncorrelated returns, often 300 to 500 basis points above publicly traded securities over the long run. From your research, Dr. Syvrud, how have you seen the increase in accessibility to private assets change the game in high net worth portfolios? The thing with private assets, is the variance of returns can
Yes.
be way broader. If you look at your typical S&P 500 index fund,
Hmm.
the variance between the good, the bad, and the ugly is far narrower than the good, the bad, and the ugly in, say, a private equity based investment strategy. I think you would agree with that.
Yes, absolutely. All research universally will show that the dispersion at that manager, that strategy level in private markets is significantly wider than in the public markets. So, what I will caveat is that everything that I'm going to say after this is conditional on you having good manager selection, right? There being a good due diligence
The key
platform.
part, a
Yes,
key,
absolutely.
we've talked about this, and I'll say if you just chime in on that real quick.
Yes.
So, as you know, One Capital had entered into a relationship with Wilshire,
Hmm.
and the Wilshire Fund is sort of our overarching private equity, private credit infrastructure strategy. And the key part of the reason we retained them was because of their expertise in that space. I think they have like $1 trillion, a trillion. So one
Yes.
twentieth of all the assets are
Yeah.
basically being overseen in that space by Wilshire. They have a lot of experience. So the manager selection very, very, very important to this overall
Yes.
having a successful outcome, basically.
Absolutely, absolutely. So once you get rid of all those ugly, right? So hopefully you're left with the median and the good and the best. When you look at the median private market fund, in general, they are offering you a higher return profile, especially in private equity, right? I don't want to, there are other asset classes in private market, but in general, we'll say private equity, the median player is outperforming the median player in the public markets. So one way that you can have these benefits to your portfolio is you're getting that return enhancer. Now, caveat, there's always could be increased risk, so you have to take that into effect. But as you mentioned, there's this diversification aspect where the returns of the private market assets tend to be lower correlated than what we see in the public markets. Meaning, if you take a 60-40, 60% public equity, 40% public bonds, and you look at the correlation of that blend to some of these private asset classes, you actually get an enhanced risk-adjusted return by adding in a slug of private markets. So you might get a little bit of return bump, or that's one way that it helps you. But the other way it helps you is it just helps diversify that risk out. So even if you were getting the same level of return, you're getting it at a lower level of risk. And ideally, you could take the same level of risk that you were comfortable with before, ended up with a higher return. So either if you wanted to match your return, you now have a lower risk in doing so, or if you matched your previous risk, you're now generating ideally a higher level of return. So either way you look at it, you're getting a better return compensation for the level of risk that you're taking. And I think we all like to make money, but when it comes down to it, what we all hate even more is losing money. And so
10
having that
times
risk,
more, I think the variable, I think I think it's 10 times more. People
yeah.
hate losing money 10 times more than they like making money.
Exactly, exactly. So having some of that, risk mitigated and having some of that diversified income streams is one of the benefits that we do see and how that can really enhance the overall portfolio construction with the addition of these private markets.
Okay, so I'm going to take you back to October when of 2025 when you were taking part in our continuing education sessions. One of the comments that you made that kind of raised an eyebrow, at least raised my eyebrows, was that your comment was that publicly traded investments are going to become more and more scarce going forward over the next few years. So that's also a factor here because the playground is shifting here, if you will. So maybe I'm going to give you a chance to publicly share with our audience what we discussed at our event in October.
Oh, absolutely. So a couple of facts on that. Let's just talk about the public equity markets for a second. If you look back in 1980, the average age of a company that decided it was private, it was a small privately owned business, and now it's going to do an initial public offering and it's going to be issued, it's public equity now. The average age of that company was about 5 years. Now in 2025, it's closer to, I think, between 13 and 14 years. So right under 15 years. That's triple the age of a firm staying private before it even goes public and has entered into a space where you could invest in it. But then on the other side, you look at the number of publicly traded companies. And that capped out at around the tech bubble time at close to 8,000. Now in 2025, we're sitting at just under 4,000 publicly listed companies. So when you look, yes, in the US,
the total number has dropped by 50%.
Yeah, since just 2000. And so you look at that and you have less companies coming to market and going public, and then the number of the existing public companies trending downwards. You think, the whole point of, oh, I'm in an index fund is because you're getting this diversification to a broad range and a broad number of investments. Well, in 2001, if you invest in the total market, you had 8,000 companies in your portfolio. In 2025, the total market in the US is closer to 3,800. Like that, you're not as diversified as maybe you thought.
The other thing about the size, I want to just chime in on another thing and on that what you just mentioned about the age of companies that we're going. But the other thing that we talked about here internally is that and you can correct me here, and I will obviously bow to you on this one. But my understanding is a lot of these companies back in, say, I'll go back to the 1990s. They would go public once they had sort of a valuation at around $500 million.
Yes.
Whereas now companies are waiting, not waiting just longer, but they're also their valuations are maybe closer to $2.5–3 billion.
Yes.
So investors that are not, if they're waiting for a company to go public, they're missing all of that upside growth.
Yes,
And
absolutely.
and I know that's a part of the conversation we had here was that, it seemed to us that a lot of the companies that were going public, the small cap, the mid cap, a lot of them were not profitable for
Mm-hmm.
one thing.
Mm-hmm.
And if the ones that were profitable, if they're staying private. So kind of got a double-edged sword.
And certainly in the era of kind of AI innovation and hype where we are now, a lot of the true innovative companies, they start private and they're not becoming public. When they, how they become public, they get acquired by NVIDIA or Meta
That's
or
right.
one of these firms, right? So
Exactly.
they're just kind of getting ported right in. But to your point, even the companies that do eventually IPO, they're huge, they're massive, like
Look
they're
what's happening
outrageously
with with
large.
with
Yeah.
with all this talk about SpaceX at 800 billion or something like.
Yes, they're massive. So you're right. I've been talking internally about like the small cap space this year. We've definitely had a reversion away from quality, right? That if you talk to any small cap managers, like, yeah, if you have any quality tilt, you've been getting kind of annihilated. It's a junk rally right now. And my thought is like, is that just how it's going to stay? Because the quality small are staying private, and it's the private investors that are getting that kind of innovation and the run up. And you're just not going to see it in the small cap space the way we have in the last 20, 30 years.
Right. You know what? I know this could be a game of tennis. We can go back and forth on this for a bit. So in the interest of time, let's get to our three questions. And
Yes.
again, the topic today is the three questions high net worth investors should ask before increasing their exposure to private assets.
Mhm.
Are we ready to go? Good to go? Okay.
Ready.
Question number one. At what point does the lack of liquidity become an issue when investing in private equity investments?
I would
The
say,
floor is yours.
yes, I would say that the issue with private markets broadly and how I think about it is these are very long-term investments. A lot of them, even we're talking traditional drawdown structure, but I'll get into the new structures now. They lock up your capital for kind of 7 years would be a short time horizon. And the average is closer to 10, maybe even 12 now with some extensions. And so when I think about how I, as an investor, think about my liquidity, if I'm going to invest in private markets, I want this to be money I feel completely comfortable locking up for a minimum of 10 years. That means no emergencies. I have a different emergency fund. I'm not planning on needing the capital that I put in private equity to buy a new home or to fund a wedding or to send a kid to college. At least in the next decade, this is money that I want to not touch. It's kind of similar to when you own a home, right? It's like you buy a home. That's not a liquid asset. That's a big, meaningful purchase that, yep, you can sell it if you have to, but most of us don't go into a home thinking, oh, I'm going to sell out of this the next quarter or even the next 2 or 3 years. It's viewed more as a long-term investment. And
That's speculation. Just we
yes.
don't. I don't even call that investing. That's speculating.
Exactly. And Wayne, we discussed at the beginning that there has been some innovation in the structures, and your clients, the Wilshire Fund, for example, is one of these 40 Act funds that allow you to have quarterly redemption. So even though it is invested in private markets, there is some liquidity,
There's
semi-liquid.
limitations. Like I think
Yeah.
the fund. I think the Wilshire Fund allows for like a 5% cap on, and there's almost like a lineup of people who are in line looking to get in. It's
Yes.
once if you're at
Yes.
the back of the line, there's no guarantee.
Yes, and exactly. And that's the thing. It's like there are semi-liquid structures like these funds that do have the ability to have kind of like an emergency release valve. But I would say that's not how you want to enter it, right? You should
100%.
go into it thinking,
I like
even
it.
though it has the quarterly redemption, I want to be in this for at least 10 years, right? That should just be the thought of it. So it's like, when does a lack of liquidity become an issue? The second you think you need that part of your capital, that part of your portfolio within a decade, probably should not be locked up in a private market type structure.
With the exception of a few rare cases that I look at the key element of asset allocation, publicly, private, fixed income is having a very clear understanding of a client's liquidity
Mhm.
needs. So for me, what we always do with all of our clients is we really get into the weeds with capital forecasting. I really like I have a document I've been using, I swear, for 25 years called an expense and income planner that I get every one of my clients to complete so I
Mhm.
can see what they're spending money on. So I really have a good idea on their liquidity needs. I think that's super important for any client to is like when, how liquid do I have to be? And I think that's a good starting point. So liquidity, super important, understanding it and advising accordingly. You do not want to, like you say, inadvertently. And again, I know the allure of private assets, like you talked about earlier, the higher anticipated returns, but the liquidity is something you have to always be mindful of.
Yes, certainly a
And
trade-off. Mhm.
yes, 100%.
Mhm.
Again, our topic today is the three questions high net worth investors should ask before increasing their exposure to private assets. Our guest is Dr. Kelsey Syvrud. She is the assistant department chair and associate lecturer in the Department of Finance at Florida State University's College of Business, and love having you here today. Let's get on to our second question. My financial advisor suggests that we increase my exposure to private equity and private credit investors from 5% to 10%. One of my basic questions is just how safe is my money?
I
Over
think
to
there's
you.
a couple ways to think about what safety means here. Now, presumably, your financial advisor and the fund that they've chosen has gone through extensive operational due diligence. That is one
Right.
of the key components when we're looking at these funds is what is the you don't want a one of these hedge fund scenarios that the horror stories that we've read where it's a Ponzi scheme and all that comes out. Well, that's the operational side, right? Making sure there aren't red flags in the accounting, that they're kind of transparent with the books, there's a clear structure, there are reports that are audited by third parties, valuations are looked at. So some of it is operationally, did we pick a good structure? But that could be true for active public fund managers as well, right? There's this am I in a legitimate firm? Is my money being managed by a legitimate person?
Am I
So
investing in moose pasture mines here?
exactly. So assuming that we've got that operational side of it, I think maybe the other part of your question is the risk, the risk side of it. And part of that fear comes from the lack of transparency that can be more associated with the private markets than the public market. Yeah.
Exactly.
And I think two things to that is one, the 40 Act structures, like the tender funds and the interval offer funds, they can eliminate some of that because now you will have mandatory quarterly reporting where they do have to give you some information where in the drawdowns you don't. So you do start having a little bit more of that kind of public feel in terms of the reporting that you get. But the volatility, right? The volatility of like, hey, I can't see it. What's going on? I don't have that daily check. I can't pull up my phone and say, hey, what is Verizon doing today? You can't do that for SpaceX right now, right? You can't do that. And I guess I would challenge is like, does it mean it's not safe if you can't see it? Or does it just mean you don't see the daily moves? You don't know, you're just less ability to see it does not mean that it's unsafe. So I would say as long as the due diligence for the fund has been done appropriately and the operational side is there and you believe in the fund's philosophy that they're good at selecting the right private market investments, just like you would believe an active manager is good at selecting the correct public equities, the safety is going to be based on the type of asset it is. Is a large cap growth riskier or less risky than an emerging market small cap stock, right? There's different risk profiles, but I'd say it's not so much about safety, it's more about risk, and that's going to come ultimately down to the individual's risk tolerance and their ability to understand that, hey, yeah, these may be a little bit more volatile than you would have in public markets.
Yeah, and I would say that most people don't measure the value of their home
Yes.
on a daily basis,
Yes.
right?
Although maybe they're looking at Zillow every day now. I don't
Yeah,
know.
I hope like heck they're not. But I'm just saying that the reality of it is no one measures the value. And I think that's the way they kind of have to think about private assets is that
Yes.
you can't measure the performance of these assets the way you do publicly traded stocks or bonds.
Mhm.
So just as a follow-up, what due diligence steps should investors prioritize to to assess the safety? Like what can a layperson do to kind of figure out, is this, am I going to be okay? Which is obviously most common question most people are going to ask. Is this okay?
Yes.
What would you say that at that level, what kind of due diligence would you suggest?
If I'm an investor, so I'm like, Wayne, you've got it covered, but I'm still your client, and I'm just interested in doing my own kind of high level perusal of based on what you told me.
Right.
One, just do a quick Google, do a quick search, do a GPT, whatever your preferred mechanism this day of the firm name itself. Make sure you don't see any kind of major lawsuits coming out, right? That'd be a red flag. You can kind of do some smell check that way. Is their assets large? You know, if I saw a fund manager that only had $1 million under management, I'd probably like, yeah, that's not really the size I want to be in. I don't know. Also look at their website, read some of the bios of the portfolio managers. Do they say they've been doing this for decades, for 30 years, or is this their second year and they look more baby faced than me? Maybe not the team I want to get behind if they haven't been in the space for a long time. But then I think on the actual like what the fund is, it's remembering that just like with public markets, you would not think of equities as having the same risk profile as you would with bonds. The same thing is true for private markets. It's not all the same. It's not homogenous. Private equity is going to have a more risky profile than, say, private credit in general, right? I'm talking on the
It's
average.
just such a broader variance of types of companies within that
Yeah.
space.
Yes. And venture capital, even riskier than private equity. So I think it's also just educating yourself at a high level about what the kind of major asset classes are in private markets and understanding where they generally sit in this kind of risk return spectrum. So that if Wayne, you come to me and say, oh, this is a stable income, this is like your bond like feature, I'm putting you in venture capital angel investing. And I would be like,
Yikes.
no. Those two things don't match, right? So a little bit of is like this education of yourself of just understanding you don't have to know the specific portfolio companies, but just like you would know, hey, equity is generally riskier than bonds, understanding venture capital is riskier than private equity is riskier than private credit, and kind of
And
knowing
angel investing is when
exactly is that kind of knowing that high
we're into
level.
family and friends now,
Exactly. Right,
or
right.
friends
It's
and family.
that smell test of like, when something's not matching up here.
Yeah. So I think when it comes to, I think we talked about this before. The key part of being successful in this space, from what and I know we talked about earlier, but I just want to maybe repeat myself here a little bit, is in this space, it's the hiring of managers with in-depth knowledge of these assets, of this space is critical. Again, because we talked about earlier, um, the variance of returns are so immense. And that's why, One Capital decided, you know what, we want to get into this space. We recognize we need to, but that's why we partnered with Wilshire and Cliffwater. Cliffwater does private credit exclusively for us. Wilshire has more of a variance of private equity, private credit, and infrastructure. But the key reason we retained those firms was because of their expertise in that space, that they would do the due diligence to select these companies. Again, these are not publicly traded companies. They're buying companies that, again, they don't normally have the same kind of access to information as we can get when we're doing research on Nvidia or AT&T or whatever company it is, or ETF even that we want to
Mhm,
invest in.
mhm.
So key manager selection, very, very important. Any
Absolutely.
final thoughts on that before we wrap up with question number 3?
Yeah, I would just echo your sentiment there. When you and I were just talking about the due diligence steps like a client should look at, that is so surface level. The amount of diligence that Wilshire or Cliffwater and these people are doing on these private markets, it's incredibly time consuming, much more time consuming than what they do on public markets. I think I shared with you all at the October meeting a due diligence questionnaire that you might see these private markets do, and it's 55 pages long of just questions, 55 pages of these detailed questions, and you need to ask auditors and you need to look at their valuation models, and there's no earnings transcripts for you to listen to. So I just echo what Wayne said. It is an incredibly complex process to really underwrite these things well. And so choosing someone who has the experience and who has done it specifically in private markets is absolutely the right way to go.
All right. Well, we got one more question to go, and I must admit I've been looking forward to this one. All right. Question number 3. I
Mhm.
keep hearing that anything less than 20% exposure to private asset only adds complexity but doesn't improve long-term returns. Is that so?
No. So,
That was great,
yeah.
but I swear I warned you, no yes or no answers.
Yeah. Next, no, yes. So, yes, a lot of the average research right now is showing it's kind of the target allocation is that 20%, but one that's not 20% isn't right for everybody. I want to caveat by that. I would say that if I had a client nearing retirement age, I'm in the next 3 years, probably not putting them in a 20% private market sleeve. What did I start this by saying? 10-year horizon, right? You kind of need a 10-year horizon at least to go into the private markets fully. So I certainly wouldn't have a 20% exposure to them. I think you start seeing benefits around 5%. I think as little as 5%, you can start seeing some benefits. But let me caveat what I'm talking about in this exposure. Just like you could buy an individual stock, or you could buy an individual ETF and consider that your entire portfolio. Neither of those would be I would not recommend you have one private equity portfolio company investment or even one private equity firm that you're invested in, right? That is not diversification. I think when we think about this exposure, you really want a well diversified exposure in there that does not always have to add complexity. Part of the structural changes that we've seen, the Wilshire, the Cliffwaters, they are creating, just like a mutual fund is a diversified portfolio of public equities, or can even have multi-assets in there. You could have bonds, you could have gold, etc. There are these private market structures that are aggregating and creating a fully diversified private market exposure for you that can create that slug and kind of take out the complexity. Historically, you had to be in a drawdown fund. Now you're dealing with K1s. If anybody on this podcast has heard of K1s, you know you don't want to do them. But these 40 Act structures give you a nice 1099 tax efficiency. So I think some of the complexity in terms of just paperwork and budgeting and taxes, that's gone away. That has kind of minimized with some of these 40 Act structures that exist now. And yes, are there more fees? Yes. Is it something you're unfamiliar with? Yes. Does that mean that it's not worth it at a 5 to 10% exposure? No, but I would say that if you go in at that 5 to 10%, you definitely want to be in one of those diversified funds. You do not just pick one private equity off the shelf and throw it in there. It does need to be a diversified kind of perspective there.
I got one extra question on this one.
Mhm.
Do you actually think, realistically speaking, there is an actual sweet spot allocation for high net worth investors that are looking for diversification? And I'll say that without, the caveat being they don't want to overcomplicate things. Is there any type of a sweet spot, or is this like the DNA perspective where every individual, like, is there any kind of like, can anybody definitively say, well, an appropriate allocation to private assets is fill in the blank number?
And yeah, let's take out like the time horizon and thing from it. If they were unconstrained by time horizon and kind of liquidity constraints, I'm going to get nerdy and talk about
Good.
modern portfolio theory and mean variance optimization, right? So I'm coming out with the academic, but if you look at the
Why you're
academics
here.
have optimized. And optimization says that risk reward, right? That thing I said in the beginning is like, where am I optimizing the amount of return for the amount of risk I'm taking? That is that 20% slug. So that's kind of why you see that is that you do start seeing meaningful risk return adjustment when you get to 5. 5 is kind of the minimum. I wouldn't really recommend below 5. So 5, you start seeing that return relative to risk increase, and 20 is kind of where it caps and kind of maximizes out and starts bell curving a little bit. So that's why you see that 20 is there is a lot of statistical numbers going around in the background that's kind of the sweet spot, I would say.
All right. Well, we talked earlier about the possibility of a smaller pool of publicly traded investments to choose from as we move forward. Are you seeing any emerging trends in the private asset space that high net worth investors should watch for going forward in the coming years? So, we're seeing private number of publicly traded companies, the number is starting to shrink. Do you see anything happening on the other side?
Yes, a couple different things. So I'll start at the asset class level. So I'm talking here private equity, private credit, real assets, infrastructure, and hedge funds, if you want to include that in the kind of semi-alternative space. Those trends are very macro oriented or cycle oriented, just like you would expect in the public markets. And I'd say there's a lot of uncertainty in the markets heading into 2026, a lot of exuberance, but also caution. It's kind of this weird barbell of like, I'm really excited, but I'm also really scared. And so, so I think that we have, and rates have come down. So I think private credit was certainly the du jour child of the last 5 years when we've had increased rates. Part of that is the floating rate nature of private credit. As
Mm-hmm.
those rates come down, it's not that it's not an exciting space, and I wanted that's why I wanted to caveat there's some
Yields will
subtext in
still
there.
be attractive,
It is
relatively.
still. Exactly. But I'd say like it is not the favorite now. It's still in there and still holding on. And I want to talk about some sub assets in there. But I think we see people trending a little bit more towards hedge funds a little bit as having some of that non uncorrelated correlated stream should there be kind of black swan events. I think we see some trends in real assets and infrastructure, particularly capitalizing on that AI trend. Data centers are being financed in the private market space. All of these photonics and these new AI companies or words that I don't even understand are coming out in the private market space. So some of this real assets and infrastructure can be exciting in that you're capitalizing on the picks and shovels of the AI field that's out there. And then private equity has been kind of calmer while private credit was more in favor these last couple years. But I think people are starting to see a resurgence in private equity. So I think that's getting a more favored outcome going forward. Now, within private credit, we're seeing a lot of interest in asset-backed finance, right? ABF. That is kind of a growing field and an area in private credit. You might have seen, I think, was it Meta? One of them funded the one public company funded their data centers with private credit. So again, you're making that AI play with a public company in the private market space. So I'd say emerging trends in general, definitely the AI innovation field. You can do that. I don't want to say better, but you certainly can have a lot of opportunity in the private market space. And then if you're feeling some of that uncertainty, I think we see general trends of just going into some of these more defensive, uncorrelated private market assets in expectation of maybe a choppy market next year.
Okay, before I move on, I got one other question, but I just want to. I don't know, it was last weekend. There was an article in the Wall Street Journal. I don't know if you saw that one about how these a lot of these privately held businesses are being offered up to the stratospherically wealthy before they even have a chance for, you know, even endowments or any other pension fund or anyone, and basically coming in and snapping up shares in these companies. I don't know.
Yeah.
Did you see the article? Did you
I
read?
did. It was one of the yes. I actually have it up right now because I was looking at it. It has the number of public companies charted on there. But yes, there was like what 50 investors were asked to be invited into the
They're
last
all
open
coming to these
AI.
little private meetings, and they're all
Yes.
like,
Wayne, are you in those meetings? Are they
I
calling
was
you?
no, I didn't get the invite,
Yeah,
unfortunately,
me.
sadly.
I'm hoping. I think I'm number 51.
Yeah,
I'm
yeah.
waiting for the
I'm
call
like,
any day.
yeah, I'm like, and I looked at that and I'm going, well, Elon and the boys all get together and decide how many. This is even before, our friends at Wilshire even get
Mhm.
a kick at the
Yes.
can here.
Yes.
That was an eyebrow raising article. I got to tell you right now, that was
Yes.
like, hmm, what does that mean going forward? Right. So
Yes. I.
anyway, interesting times.
Mhm.
Okay. So we know that more and more people are starting to get introduced to private assets.
Mhm.
What do you think is one of the most common, the misconceptions that people have in based on your experience? Again, I'm going to lean on your professor role here. And what they can people do to avoid that misconception that they have?
Mhm. I think it kind of goes to some of a kind of a combination of the questions we asked earlier, which is I think people think it's really expensive and it's really risky. And I would say that is a broad generalization. First off, let's talk about the expensiveness. Yes. If you look at the fee expense ratio for a private market fund relative to an S&P 500 ETF fund, yes, numerically on a percentage basis, it's going to look significantly higher. But as we always I tell all my students, you do not care about the gross return, and I do not care about the flat fee. What I care about is that net of fee
Net
return.
return, yes.
Exactly. Do I care that I'm paying you a ton of money if you are still making me way more than I would if I was paying a cheaper fund to make me less, right? It's all about that. Yes, you will see higher headline numbers, but as long as they are giving you a higher net of fee return, that is what matters on that fee front. And then on the risky side, I think that is just a generalization. Like I said, it's like private markets are a huge variety. That'd be like saying, oh, all public equity, all public markets are super risky. Well, not really. Like treasuries and tips, like they have different profiles there. Same thing. You have real assets and real estate is often called it, that's a private market investment. There are more stable, income-oriented, less risky private markets. And so I think kind of lumping it into they're all super risky. We just have this venture capital, private equity more mindset in our heads. And yes, that is very risky and riskier than in general public markets, but that's not fair to push across all private market space. There are income-oriented, stable private market investments.
I would always remind clients that you allocate your money in relation to when you need it.
Mm-hmm.
For example, it's just as big a mistake, for example, to invest your long-term viewed investment in a 1 to 3 month treasury investment, right? I mean,
Mm-hmm.
well, what are you talking about? Well, that has its risks too of not, achieving even inflation.
Yes.
Right. So, I mean, there's ways. The viewing risk is not all about volatility. It's about when do I need my money,
Mm-hmm.
right? So, we never recommend, investing in a small cap equity ETF if you need that money in 3 months. You know what I mean? Like, you have to allocate your money according to when you need it, right? So,
Mm-hmm.
in this case, I highlighted earlier in the podcast, if you're in whatever assets you're investing in private equity, a private asset investment, whether it's private equity, credit, or infrastructure, the way you have to look at it is, I'm not going to need that money for 10 years. So I really shouldn't even be thinking about,
Yes.
I'm not going to be checking. I remember we had this thing at the, remember how you would ask the question about how frequently you should be viewing the returns of private assets. It was, you're not going to watch them as the same way you're going to look at something that you're going to need the money in 1 to 3 months. It's just not. So you invest in terms of your time horizon.
Yes.
Well, I want to thank you so much, coming on this podcast for the first time. Maybe we'll have you back again. I'd love to personally. That'd be great. You really, I would say, educate and informed us today on why private assets are worth considering thoroughly. To recap, what we covered today was liquidity thresholds, safety assessments, and if there is an optimal allocation for high net worth investors. If you're evaluating private assets in your portfolio or the need for tailored wealth management advice, that's why you come to myself, Wayne Baxter. We're here to help you navigate these. Dr. Syvrud, how can folks learn more about you and your work at FSU?
Yes, well, you can Google my name for one. It's pretty unique. There's not a lot of other Kelsey Syvrud's running around in the academic space, but also I do work at the DeSantis Executive Education Center at Florida State University. That at the College of Business, there we focus on continuing education programs in private markets. They're certainly focused on the financial advice, but we do have some for the everyday investor who just wants to learn about private markets. So you can look at the DeSantis Center, the Florida State College of Business with alternative investments, and you'll see some of our offerings in both live and online formats.
Kelsey, thanks a lot for joining me on the podcast. It was great having you. I really appreciate it. Dr. Kelsey Syvrud is the Assistant Department Chair and Associate Lecturer in the Department of Finance at Florida State University's College of Business. Thank you very much for joining us today. I look forward to bringing you the 3 Questions podcast, and I hope you find them educational and informative. Please consider liking this video and subscribing to our podcast and YouTube channels. And to receive a notification of when our latest episode has been posted, please click on the notifications bell. Lastly, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.capital.com/meet with Wayne. Thank you, and we will see you soon.